News out late Thursday put Federal Reserve Bank of Atlanta President Raphael Bostic in the headlines, and not for the reasons you might expect. Taking a look here, we see, according to the financial disclosure forms, Bostic's money manager bought and sold shares of 19 exchange-traded funds ranging from $1,000 to $50,000 during the FOMC blackout period in May of 2022. Joining us now to discuss is Punchbowl News financial services reporter and author of the Vault newsletter, Brendan Pedersen. So, Brendan, I want to get your thoughts on this at the moment. Obviously, something that we've seen Bostic under scrutiny for before.
Yeah, thanks for having me, Rochelle. This is not a good look for anyone at the Fed, unfortunately, but we have seen the Fed weather this kind of scrutiny in the not so distant past. And this is ultimately like kind of a smaller deal than the string of scandals we saw in 2021. Obviously, Bostic is a member of the Federal Reserve Board. He is not currently, however, one of the Federal Open Market Committee's voting members. He is not deciding monetary policy these days, but he is a voice in the room, and obviously he has information that members of the public might not have. So it's not a good look, but when you're thinking about how DC is going to respond, it's a little bit hard for me to see it moving the needle. There was a whole lot of controversy around the stock trades involving former Fed presidents Rosengren and oh my gosh, his name is escaping me. I'm sorry. The Kansas. I'm not going to try to guess. Long story. Thank you. Those were pretty bad and pretty flagrantly poorly timed as far as political optics go. I think we've already seen this bonfire in D.C. burn, and there's a little bit of tinder left there. We're going to see probably some criticism from progressives like Senator Elizabeth Warren and others like Senator Rick Scott, a Republican who has teamed up with Warren in the past to pursue some Fed accountability legislation. But big picture, it's hard for me to imagine that we're going to see too much of a reaction here.
Okay. Well, why? I mean, I guess there's just so much question around why there are so many legislators, so many people in positions of power, either elected or put into those positions, appointed by the staff or the president himself, that are allowed to have different type of regulations or just trade freely, more freely than a lot of other people who work in these industries even. And they're the ones actually pushing not the agenda, but they're the ones maintaining policy.
That's a great point. Here's what I'll say. I mean, to a certain extent, it is a matter of degree. These trades from Bostic are just a sort of a lower level concern than those that we saw in 2021. And this is on the heels of the Fed actually instituting a bunch of new rules that prohibit these kinds of transactions, to be fair, during the blackout period when the FOMC is voting. If you look at the stories that have come out, it seems pretty clear that the Fed officials and Bostic has been messaging that, look, we didn't actually know that money manager transactions like this were covered by the new rules. Call it a miscommunication, call it whatever you want. It's just a little bit smaller of a deal, but I really don't want to discount the public damage that this will continue to inflict upon the Fed. The Fed is by no means like in the hottest water right now that we've seen, but it's certainly not in the plummest of positions either. There are a number of legislative efforts out there, like I just mentioned, to encourage some better transparency and accountability at the Fed, introducing a newly independent inspector general to police the Fed's behavior. These are all things that could make the Fed's life a little bit harder. And it only takes so much controversy to get Congress more and more involved. But the other side of the coin here is that it generally takes Congress in a crisis to get lawmakers to act. And we're just not there yet. It is an unfortunate symptom of the way in which our government works, but we're not at that crisis level yet.
Well, guess what? We did have a crisis in another area, Brendan, that you're also taking a look at. And that, of course, was the crisis surrounding SVB, the sort of mini banking crisis, as some have termed it. And there, because something actually did break, now Congress is stepping in to try to do something about it. In this case, clawing back some of these executives' pay. This was something that was sort of talked about in the wake of it, but now it looks like there's actually action. Tell us about it and how likely that is to get through?
Yeah, so the Senate Banking Committee and its chair, Sherrod Brown, and the top Republican on that committee, Tim Scott, announced that they have a deal to introduce the first really meaningful guardrails or curbs on banker behavior since 2010, and that is the Recoup Act. It's all about recovering executive compensation at banks that have failed. You have to remember, when you look back at Silicon Valley Bank's failure, the controversy was partly how quickly it failed and how badly it managed its interest rate risk. But the other side of that coin, and what lawmakers really remember, is the stock trades, the very lucrative stock trades that were technically scheduled in an orderly fashion by executives, but they were pretty high level stock transactions and only scheduled a couple of months out before the bank ultimately failed, a period in which the bank executives knew that Silicon Valley Bank was in trouble. So, long story short, lawmakers are interested pretty keenly, and have been for a while, in introducing some kind of guardrail or curb on that kind of behavior, on making it harder for bank executives to carve out or kind of craft themselves a golden parachute before their institution implodes, especially when they know it's on the brink of doing so. This is a pretty interesting bill, and I think it's got a pretty good chance of finding meaningful bipartisan pickup in the Senate. And so we're going to be tracking it very closely.
And one of the pushers for this bill, Senate Banking Committee Chair Sherrod Brown, said Americans have watched executives take their money, run banks into the ground, and get away with it too many times before. But is taking the pay angle, is that the best way to actually get accountability in this sort of situation?
You know, that's a great question. We have talked for years now, really a decade, about like the best way to police banker behavior. Obviously, a lot of things went wrong in 2008, 9, and 10, and not many bankers, if any, went to jail for crashing the American economy. Today, we are in a different kind of crisis. It's a little bit less existential, and the reforms we're going to see are going to match that. They are going to match the moment. And to be clear, financial services legislation is among the most difficult types of packages for Congress to pass at any particular time. I mean, like, legislation is hard in the best of times. Financial services legislation is tough because the banking lobby is tough and the issues are technical and don't exactly carry a lot of salience for the American public. This is a long way of saying that these curbs on incentive pay, let me lay out that point a bit more clearly. The Brown-Scott package, the Recoup Act, is focused on incentive-based pay. It does not include salary. The important thing to note here is, as many of your audience members probably know, a lot of bank executives, especially at large banks, get the majority of their compensation through stock incentives, bonuses, and other things that aren't actually tied to salary. I think Jamie Dimon's salary is something near $35 million. Sorry, his compensation in 2022 was close to $35 million. His salary was only 1.5 of that total. So, bearing in mind that this is a little bit more limited than other bills that are in the mix from progressives, this is a pretty meaningful bill. And it is something that could, in theory, change banker behavior. If I had $30 million coming to me, I would think a little bit harder about just how carefully I am managing the risk at my bank.
Indeed. Hopefully I get to that point at some point. A big thank you there to Brendan Pedersen, Punchbowl News financial services reporter and author of The Vault, Punchbowl News newsletter. Thank you for joining us this morning.
Thanks so much.